Gentlemen, welcome back. Well, right now we're on another incredible panel discussion, which is right now on the future of risk management challenges and opportunities created by a rapidly changing environment. Well, right now we've got with us our moderators, Dr. Rabi and Mishra, former Executive Director, Reserve Bank of India, who's joining us back, a central banker for more than 3 decades and a half. Dr. Rabi and Mishra was the Executive Director at RBI till August 2020. In this capacity, he was looking after the areas of supervision of banks, urban cooperative banks, and NBFCs in India. His academic professional expertise hinges on macroeconomic policy issues, regulation, supervision, financial crisis resolution, macro financial surveillance, and risk management. We're also joined by Mr. Sunder Krishnan, Chief Risk Officer, Reliance Nippon Life Insurance Company Limited. In a career spanning over 3 decades, Sundar has dedicated 14 years to Reliance Nippon Life, wherein he's been at the helm of enterprise risk management and internal audit, BCP, information security, legal, claims, and compliance. He has used technology to implement a risk-based strategy across all these functions. His experience spans more than 12 countries in a significant role with exposure in banking, business, and operations. We're also joined by Mr. Avez Syed, the Chief Risk Officer, SBI General Insurance Company Limited. Avez is an insurance specialist with more than 15 years of experience managing business strategy, risk, information, and cybersecurity. He's regularly involved with regulator as part of the various working groups and is actively involved in developing and building risk management practices within insurance domain. We're also joined by Ashutosh Mishra, Chief Risk Manager, National Bank for Agriculture and Rural Development. Ashutosh has worked across various different companies and roles related to credit, operations, and business development. He's an alumnus of IIFT New Delhi with a law degree and certifications from PRMIA Premier out there. Also, ladies and gentlemen, this entire panel discussion is going to be moderated by Ms. Seema Nayak, Chief Compliance Officer, National Commodity and Derivatives Exchange Limited. At NCDA-EX, Seema is responsible for the exchange compliance, membership, inspection, investor protection, and enforcement. She started her career with the OTC Exchange of India, after which she served the NSE for around 16 years. In her earlier role, she's handled a wide spectrum of functions, including membership surveillance and investigation, business excellence, and business development. So thank you so much to the incredible panel for joining us, and I'd leave it in the able hands of our moderator, Ms. Seema Nayak, to take it forward with her panel. Over to you, ma'am, and thank you once again to our panel for joining us.
Thank you so much, Bhavna. Good afternoon, everyone. I'm Seema Nayak. On behalf of the panelists here, I welcome you all and extend our gratitude to the organizers for having us here today. Well, we have had interesting sessions since morning. We have covered finance, we have covered automation using technology. In the sequence of events, it naturally flows that risk comes next. The topic for our panel discussion is the future of risk management, challenges and opportunities created by rapidly changing environment. Friends, we are all aware that the role of CRO has evolved in the last decade or so. Risk managers who are traditionally concerned with relatively precise science of quantifying risk and offsetting them, today in their current avatar are dealing with diverse and nebulous issues as headline risk, IT failures, impact of a new regulation, and the most recent, even a medical pandemic. Effective enterprise risk management is crucial if businesses are to successfully adapt to future conditions. No wonder then that CROs are now a part of the C-suite and are seen as an integral part of the senior management team. Another interesting development in the risk function, as in respect of any other function, has been the impact of technology. We often use the tongue-in-cheek term of, use your degree and not your Excel skills. What this actually means for the risk team is that, which is made up of intelligent people, is that they can do away with the mundane tasks and actually do things that they are hired for. In fact, the pervasiveness of technology in functioning of organization also sets forth new and unknown challenges at times for the risk managers. Yet another challenge that is coming up before the risk managers today is probably the business continuity. Business continuity, which is defined as the ability to sustain operations even in the event of a disaster. While most of the financial organizations have alternative business sites and duplicate networks towards securing business continuity, the recent global pandemic has made one question underlined, whether all this is actually good enough. Well, we will touch upon all these aspects in our today's discussions, and we'll be also happy to take any questions, like Bhavna mentioned, that you would have, and probably take them through the session as well as at the end of the time permitting. On that note, I'll get into discussion with first of our panelists, Dr. Rabi Mishra. Sir, you have a veil of an experience behind you. You have experienced firsthand evolution and redesigning of the financial sector. This redesigning in turn implies that the contours of many of the traditional risks are now changing and newer patterns of risk are surfacing. Given this background, how do you see the role of CRO reconfigure itself?
Yes, thank you, madam. What I'll do is to ensure meeting up ideas on potential areas of equality. So I will choose some items which, as a supervisor of financial sector, I will expect on a CRO. So my first point is, in the changing dynamics, CROs should understand, point number one, risk models are not enough. Managerial application of mind is also essential. And why I am telling, as I quickly told in the morning, I'll give the examples of at least credit risk now. Because it's a huge topic, but I'll just like, because of newer challenges to managing risk, now commonsensical approach is also required. For example, credit risk, slower loan repayment. How do you cannot do anything about it now? Even basic things, stress testing, scenario building, the Avez and all will know. So we never had thought of a doomsday scenario having 6 sigma built into that. So maximum we had gone up to 2 sigma. Okay. So now even the risk model itself has got to reconfigured into taking care of 6 sigmas. There also there is a problem, because 6 sigmas are one in a crore kind of event, one in a century, and you should not again create a model taking care of that, which again minimizes the effect of other variables. If you add one variable in a statistical model, others get minimized, and here is a rare event. So we have to rethink of the entire modeling concept, both from statistics and with common sense. Second, falling collateral values. How do you now, unless you apply your common sense, how will you fit into a model? What should be your past experience? What models calculate? So they go for a historical what has happened and how it will likely be in the future. So now it had never happened, and collateral values fall across sectors. Then within individual performers. Next is adverse sectoral concentration risk. Now what will happen? Type of recovery curve for growth rate. So to inverse V's, so the because below V's are likely to perish, and the above V, real V, is likely to boom. So there will be a tendency of every organization to catch up with rate of growth, to go in for those sectors. And naturally, inside the same institution, there will be a high concentration risk. And earlier days when I was a youngster, we had fixed the limits. You cannot go beyond 10% of your credit to any sector. But now that is gone, board only will decide. And board, as you know, there are other issues. So CRO will be the only person now in the board who has to give a realistic picture of how it should be done. Guide the board there, not just be a part taking the flags or criticism or the instruction of the board. At this point of time, the role will be vastly different and very challenging. Then worsening of balance sheet quality. You cannot say CFO is responsible for that or business head is responsible for that. And there is a huge fungibility in operations, as I find, being a CRO of Reserve Bank myself. CRO has a unique role here. While CFO can say, one X, Y, Z I am not supposed to do, CCO can tell X, Y, Z I am not supposed to do, CRO cannot say. Other than, of course, cyber risk. Cyber risk, it has now been bifurcated. Another gentleman is doing. Anything happening anywhere. So is a risk. Wherever there is a possibility of an event rising, incident, that is called incident, operation risk incidents, there is a risk brewing there. And CRO is responsible to handle this. Not look at only models as I told you. The next, because all the off-balance sheet quality will be very rapidly deteriorate now. When on-site itself has fallen, that also will fall. And that is a gray area. Who should handle that? And that is where CRO also should run an extra mile to redesign himself. If he is not yet equipped, why not equipped? It is assumed of the CRO to be totally abreast of all business functions of an institution. So that is why Reserve Bank as a supervisor averse the idea of putting anybody as a CRO. When supervisors ask, have you got an independent CRO, they will catch hold of somebody and put as CRO. So that time is gone. So it has to be, he has to have experience in our business unit is a must, but at the same time should be equally well versed with everything. Next, scenario building I told you. Now this very quantification, collection, collation and assessment, and all have gone array at this point of time. And this is very important to direct the board to streamline policy measures for the institutions. If this is a topsy-turvy, for which CRO is extremely responsible, he has to relook how to get them organized. Because he is collecting data from business units. They are at trouble. They are working from home. So the quality of data itself is suspect. Also he has to get involved. He should not say CEO is responsible. How people are working at home. So that is also his problem. Then I think as an example, I have got examples in market risk, operational risk, so many things. I will skip for the time being. I will just go to two, as you told, different new type of risks are coming. One is conduct risk in a different manner. All third-party service providers may show misconduct now. Okay, all business heads to show their targets will behave in a very unethical manner now. So independent assessment is done by CRO. And governance and control, we used to say it is the job of the top management, including board of directors. But now CRO will be asked to do an independent evaluation whether governance and control risks have been captured properly. Technology risk is not suppose his job. Moral hazard risk and reputation risk. I have quite two more new risks for people like Avez. What is that? Reputation risk. We had made an attempt for RBI. Of course, RBI is doing policy making and RBI reputation may be at stake if the desired objectives are not fulfilled. Now, every institution will have that. Reputation will be the variable distinguishing one institution from the other. Because nobody, the only good thing in this crisis is, as I told in the morning, level playing field is maintained. All are worse off. Everybody. And in this juncture, as I was hearing the last comment of the last panel, someone was saying this, how much quality of brain you apply is less important than how fast you adapt to this kind of new risks and managing them. The moral hazard risk, I will tell and end in my first point. It's a very, very interesting risk. I've just thought over yesterday and tried to weave it together because all are CROs. Government support for ailing companies and prospectively for weak financial institutions may create expectations that such support will be forthcoming in future's crises as well, thereby lead to risking behaviors. And there is a risk the increased role of governments and central banks in the economy, which had come through higher fiscal deficits.
Okay.
Any problem? Money printing?
I think it's working.
Bailouts?
Yeah. Okay.
I am not working or what? Oh, I think he's talking.
Mr. Mishra, I'm so
Wide-ranging
sorry.
purchases in capital market.
Yes, yes. Mr. Mishra, I'm so sorry to cut in. Actually, there's a slight audio issue on your end. It's sort of chopping, Dr. Mishra. So if you don't mind, if I can just request Ms. Nayak to just take it forward with the other speakers, if that's okay, ma'am?
Yeah, in fact, he made very important points already, and I think we have heard about him on the different type of risk, including the conduct risk, moral risk, governance risk, and so on and so forth. The point that Dr. Mishra rightly brought out is that the risk management needs to lift up from risk control to risk intelligence, which can identify the potential business growth opportunities. Well, talking about that, I think the fintech solutions that make use of the big data analytics, artificial intelligence, and blockchain technologies are currently being introduced at an unprecedented rate, which means that it is going to have an implication for the risk managers. Mr. Krishnan, if I can bring you in now, how do you think an organization can build a risk management framework that can identify and manage risk emanating from the fintech innovations without stifling their economic potential?
Sorry, come again. I lost you.
I'm asking you how the risk management framework can be built that can identify and manage risks emanating from the fintech innovations without stifling the potential that they have.
Sure. I think a very relevant question. I could pick up what Dr. Rabi Mishra was speaking, although, yeah, audio was a problem, but excellent stepping stone. He has covered all the risks that impact us. And data is the new oil. And I only wanted to add that the cyber risk, which he mentioned, is also now coming under CRO. So directly reports onto me. And unfortunately, I have to take care of that also. And I'm actually luckily a specialist in cyber risk and security. So it helped me, something I did. It's sort of helping me out, but the CISO reports to me in my organization. So cyber risk also is now added to, apart from the so many risks that you mentioned, been added to the CRO.
He should report, as per our instruction to banks and others, he has to report only to the MD or to the SCB, not to CRO.
Okay. But
maybe this rule is not applicable to you guys. Avez will know. He cannot report to the CRO. It has been banned. Okay.
Yeah. So it is also now
slowly
coming in. I can see trends, global trends. So coming back to the question, so data is the new oil now, and there's a lot of analytics that are being run, artificial intelligence being used, and of course, fintech companies are working on this. And we go into more and more higher levels of intelligence, augmented intelligence, from assisted intelligence to augmented intelligence to greater intelligence. So data, analytics, trends. Now, I mean, we used to always present the past data, what we call as lag indicator. Now from lag indicators, now we're going on to lead indicators. So you actually have to say exactly what will happen in the next 1 year. For each aspect of the business plan or the budget, what is in danger, what's in red, what's in amber, and what's in green. And you'll have to do that not by speculation, but by data. Saying that this is the emerging trend that's coming in the last month. this is emerging, this could come. Of course, there are qualitative factors also to in play, wherein you use your judgment and experience. But data is playing an important role, trends are playing an important role, and fintech companies are coming up with better and better softwares using artificial intelligence, machine learning, and analytics and big data. What we do is we do a lot of crunching, and we use that effectively harness the technology, intelligence, and data available to take decisions. For instance, I'll tell you in my own company, insurance company, uh, we have territorial, locational, geographical, analytical trends. Then we have product trends. We have occupation trends. We have uh, what they choose in the proposal form when they fill in an insurance proposal. And based on that, I had made out of intuition something like 8 variables or 9 data variables. From there, when I use analytics, went on to using combos, it went on to 36 variables. And so it's like a attack, a surgical strike with the use of data on the frauds, on the bad elements. And so you take a better decision in terms of underwriting and claims. So we used to use this and ensure that we go after the fraudsters instead of sitting ducks, and ensure that you plug in dead man insurance, you plug in people with critical illness and insured, higher age, 85 shown as 65. And we used to use data, RNS data, and use analytics using regression analysis to find out what's the pattern, what's the, then we used SAS on that, SAS analytics. And sort of, when I used to spend about 50, 60 lakhs for investigation, typically a case can be from 4,000 rupees per case to, depending on what type of investigation you do. If you do only an authenticity or identity investigation, it could be 250 rupees to 300 rupees per case. So it's a volume game. I used to spend about a year about 50, 60 lakhs, but save about 40 crores or 60 crores of sum assured. So this is what the contribution of risk management is expected to be, from a cost center to a sort of decision center to a sort of solution center to sort of where you could save a lot of money, and of course help the organization to take strategic decisions. Because we're able to bring down mortality frauds, the company is now launching mortality products, whereas it was scared to do launch term products about 8 years back. Now we have the confidence, we're making money on mortality. So it's okay, we'll launch it. So this is where the emerging role of a CRO or a risk manager is, that there is a lot of strategic inputs that a CRO brings into the table now, business decision making. And also, of course, not, as you rightly put in your question, we still have to do what we have to do. We have to do the BAU, business as usual, which is identification of risk, analysis of risk, mitigation of risk, and get into action planning, where you actually track action plans to ensure the outcomes or the asks of the board are met. So when you do that, you use data effectively, harness data effectively, and use all the artificial intelligence, machine learning, analytics, and big data to your advantage, and become essential tools now for a modern risk manager, because it's all about quantification, lead indicators from lag indicators, and also contribute to the organization strategically, because you're part of all business strategy meetings that the company has now, and in fact, part of all management meetings and board meetings. Even legal compliance and secretarial folds on. We'll have to look at the governance risk compliance piece. And every day is a new day. It's you don't know what you're going to get. It's become a troubleshooting job. So you're actually Mr. Troubleshooter. And somebody says Chief Opportunistic Officer. So we also, of course, are opportunistic. So that's the dynamism or additions that have come in the last 10 years, I can say. I've been touching notes with people like Syed Avez, so he's also will add the same thing to you, that things are changing as we speak.
Thank you, Dr. Krishnan. Yeah, you rightly put it. The CRO is today a troubleshooter, but even for him, not all risks give him time to prepare. The 2020 global coronavirus pandemic is a perfect, illustration of the same. With only a few weeks notice, businesses had to kind of adapt operations and structure or face the threat of survival. Mr. Avis, you would agree that COVID-19 has impacted every facet of the society and business. Different businesses have responded differently to the crisis. With the benefit of hindsight, what in your view the risk management function ought to do for improving the resilience of the organizations to such major crisis events?
Thank you so much, ma'am. And as rightly put up by Sunder sir and Ravi sir, I think the CROs are moving from decision center to solution center. And I normally put it that normally we are not here to protect the value. Now we are here to create value. And there are thousands of examples where CROs are now partnering with the business teams and with the strategy team to create value. And that's the reason we are looking ourselves as business partners. And within the organization also, we have changed the dialogue, what we speak to our business partners, and we say, let's look into a particular risk area and think about taking more risk into a particular area with a calculated way, right? Today in this disruptive area where, everybody's trying to disrupt the business model, if you talk about putting in more controls, the entire process becomes very control heavy. So we are talking a different language. We are saying that let's look out and identify controls which are redundant, which are not at all needed, right? That makes the entire process very heavy. And look at processes from a view that can we take more risk, and identify a sweet spot. The conventional CROs, I think, because of the time span has gone into, were much more involved into educating a particular ecosystem. Currently, the entire industry or the workforce is fairly able to understand what is risk management. The vocabulary is already there. They understand cybersecurity. They understand operational risk. They understand business continuity. Now, I think it's a time for the CROs to put in the different gear. I am too inexperienced compared to the other panel member into this domain, but my thinking is that we have to start thinking from as Sunder also concluded, from an opportunity management point of view. I normally tell to my team that we are opportunity managers rather than risk managers. So my job is to make sure that whatever opportunity or whatever objective the company is trying to achieve, I make sure that I have a plan around that the company doesn't fail. So from that point of view, I think there are so many examples. If you look at Maggie, for an example, Maggie have a huge opportunity to sell Maggie noodles in the flights, but they were not able to sell it till the time they launched Kappa noodles, right? And they completely disrupted the entire market model of selling noodles into a flight. Similarly, when Bullet, the bike, they were not able to sell more bullets into an Indian market because of the kick position. The kick was on the opposite side, which the Indians are normally accustomed of. We just change the kick from one position to the another position. So risk managers also play a different role when suggesting strategies to design team or production team. So we are now talking about risk management by design, getting the risk team involved at the design stage itself, at the ideation stage itself, and become a partner of the entire process, rather than you bring an entire finished product on the table and then ask the risk team to do an assessment. It's completely not fair in today's age. And I also think a bit different radically from a three line of defense model. I don't believe in the three line of defense model. We are saying let's strengthen the first line of defense so well that it doesn't rely on the second or the third line of defense. And the reason why we are advocating this is, if somebody relies on the second or the third line of defense, will the market give them time to recover? Today the market is so volatile. If a company fails, it's very difficult to come back again. The average age of a company today is close to around 17 years. If you look back 20 years back, the average age of a Fortune 500 company was close to around 50 years. So disruptions are also making this entire vintage of a company to the time span of a company has reduced a lot. So CROs are doing a very dynamic job, as Sunder sir and Rabi sir also said. It's you ask about an area which CRO is not involved today. Be it strategy, be it project management, be it cybersecurity, business continuity, financial risk management, culture management. We are also working on conduct risk very heavily, because if conflicts goes unmanaged within an organization, it creates a huge opportunity for misconduct. So identifying conduct at the very right stage and plugging in the cultural risk culture part, which also helps you reduce your controls. If you have a very strong risk culture layer in your organization, your controls can be very relaxed and you can have a very smooth and very fluid processes within the organizations. So that's my small take on this.
And thank you, Mr. Syed. You rightly mentioned that, the risk managers are partnering in the entire process, which actually implies that, the detection, assessment, and mitigation of risk cannot just remain a job of a risk manager alone. It probably has to become a part of daily job of all employees, not just the risk function, which means that you need to build a strong risk management culture. Mr. Ashutosh Mishra, if you can share your thoughts on how could organizations build a strong risk management culture?
Thank you, Mrs. Nayak. Thank you, Kamika, for this opportunity. In fact, I would say that the risk management starts from risk awareness. And I'd like to make two quick points. First thing is that the beginning of risk management starts from risk awareness, which means that the risk awareness covers the employees and also the organization as a whole, all the stakeholders. That is the first step. Second thing is that we need to make risk management jargon free, because I know, and having seen a bit of a risk management myself, I have seen that the risk managers all over are not able to communicate with other stakeholders, other employees, because the entire subject has become too technical. I like what Mr. Syed said just a moment back. He said that the entire thing has become very control heavy, and there is a requirement to kind of identify controls which are redundant. Having been a CRO of an insurance company and also a microfinance bank, and now heading the risk management functions of a financial institution, I believe that the most important thing is to de-jargon the risk management. That would be the beginning part of the risk awareness in an organization. All of us know that there are structured ways of starting a risk awareness campaign in an organization, and all of us done that. So making it part of your organizational intranet, then starting risk awareness campaigns in various ways. So these are very standard ways of making the organization risk aware, and all of us have been doing that. But here I would like to ask a question. The question is that if we go back 6 months back, won't all of us agree that the risk awareness has increased manifold during these 6 months, and that all stakeholders in the organization have become acutely aware of the risks that they undertake in many kinds of business? The other point is that many risks which were handled slightly tangentially have to be faced head on. Take the question of cybersecurity, take the question of internet frauds which are happening. So these risks are also to be taken upfront, head on. So what has happened is that it has taken a pandemic to make us realize across the organization that risk management is integral to doing business. But the question is, do we really need a pandemic to give us this understanding, or is it possible to do that in a way that risk management becomes part of the organizational culture? I would tend to believe that it is possible to do that without having a catastrophe knocking at your door. As I said, the most important thing is to de-jargonize the risk management. People like me who have risk management certification from FRM, PRM, having moved around, we tend to use words and then we become such a specialist that we become incomprehensible to the stakeholders in the organization. When I talk to the board, when I talk to my CEO, I find that his focus and my focus are totally different. His language and my language is totally different. I am tending to believe that it is very important to say things in the common sense way of doing that. That is a big challenge, because to simplify, I totally agree that one did not oversimplify things. But the challenge is to simplify in such a manner that the key concepts are understood at each of the steps, and then these are put at the first level itself. When we talk about loan review, the review happens pretty quickly. So which basically means that alongside doing business, you are also doing the risk management. Probably that kind of approach becomes more acceptable when the risk awareness itself is high, and that is high degree of acceptability of risk awareness across the organization. That's how I'd like to look at, and I'm leaving out all the technicalities of all the jargons. So that's what I would like to put forth.
Thank you, Mr. Mishra. Indeed, it is important to de-jargonize to increase risk awareness among the employees. A strong risk culture can be attributed to an organization that consistently takes the right risk in the right way. I agree with you. At this juncture, maybe we can take up a question from the audience. This is from Kanupriya Barasha. And the question is, what is the biggest risk factor facing corporates in 21st century? So, Mr. Avez, yeah, I thought as much.
So at least I'll be an opportunistic here. And for me, at least, I think in this particular era and the country which we are living in, I think the biggest risk, if I don't be honest, is opportunity risk. And I really mean that. We internally speak every time about this particular risk. If the country is giving us so much of opportunity, and if we are not able to take it, I think that's the biggest risk we are sitting on. And all views are my personal, nothing to do with SBI General. These are all my personal views.
Mr.
So
Krishnan,
for
would
me,
you
the
like
number one
to
risk is
take on?
opportunity risk, loss of opportunity risk. Yes, sir.
Mr. Sunder is very amused. Would you like to take on this question?
Yeah, I mean, in a way, yes. So I also highlight sometimes the inadequacy of business in terms of the plan, especially what happened in Q1 of Corona. But now Q2 we are back. Most of the companies are back in target and back as per the budget and plan. So, but the highest red risk was the new business or not having business. So that was the risk dashboard. And persistency. Persistency means payment of premium every year, year after year. So these were red in the Q1, the risk dashboard. So in a way, I agree with the ways, but also the uncertainty that is added recent times. And to measure, to be able to quantify that, measure it in a very simple manner, as Mr. Ashutosh put it, in a business language, is the key factor. You will have to also articulate what is wrong, and so the talk of the town is one of the thing is regulatory compliance again. Compliance, it's become very heavy because so many things to do, and added to that is the uncertainty dimension to that, especially the influence of external factors, reputation risk, culture, economy, what's happening, political risk, geopolitical risk, China, US election, what impact on that, the capital market. So we started measuring all this now, the external risk factors, the climate risk, environmental risk, post the corona risk, vaccine, the second wave, the risk of the second wave, risk of the third wave. We started measuring, we've seen that second wave is bigger than the first wave and third wave is lesser than the first and the second. So this is what happened a century back. So now people are worried. And of course, second wave has come in many places and impacted in some parts of the globe. So now so it's moved to this, to read up GDP studies, IMF studies, look at global forecasts. It's also the impact of external factors. So these are also adding a new risk dimension to entire risk architecture, as we say. And so we'll have to look at all these factors, the influence of these on the business and the impact of that on the business, and start measuring that. So, like for instance, I arranged for a lot of talks by economists in my organization. I pulled up economists from CRISIL and so many other parts of the country, and also research papers with McKinsey's and things like that, so that we are one of the curve and we are able to measure. And insurance industry was the number 2 impacted in the world, whereas not so in India. India, most of the insurance companies are back. With September 30th, we are all back in action and back to business and back to targets.
That's fantastic to know. It shows on the risk resilience of our insurance companies. Dr. Mishra, would you like to add a couple of lines there?
Yes. Just immediately to add to his last line, I told in the morning I had introduced a concept called catastrophization by economists, like selectively choosing the bad against the good and creating more and more uncertainty, and which creates a vicious cycle. Anyway, on which will be the worst? That was the question. What worst risk in future? And so far as India is concerned, so if we see the incidences of crisis last few years, so whoever organizations have failed, they are because of lack of governance risk only. And why governance risk is a problem? Because this is a risk which is interconnected. Like risk appetite statement to be made by the CRO was also a link with governance. Reputation link to governance. Moral hazard risk to governance. So from this way, that has become the pivot risk. And on why it is more difficult? Because CRO is not the person, he will find himself helpless in doing anything about corporate governance risk. Though he is knowing he cannot do anything, despite all independence, he is reporting to anybody you like. So this has something to do with the culture issue. As Mr. Mishra was telling, when there is an attempt to acculturize stakeholders, when we are not able to acculturate board members, so where is the question of staff members? So board members, acculturation of risk is the first job, who should do, he has to be decided, whether to the supervisor, because nobody in the organization can do it, nor the CRO. So I take it as the biggest difficult to manage risk now and in the next 10 years. Still this culture of independence is clarified. All others, MD and others can get done, CRO and MD. This one cannot be done.
Okay, Dr. Mishra, I have a different question for you. This question is from Rahul Kedia, and he's asking us, risk management is a part of our life since ages. It is not only now due to COVID-19, people understood its importance. Do you see any change in investments and approach getting changes for the near term, 3 years? I don't even know if you agree with the statement that, we have, with what Mr. Rahul Kedia is saying, that, risk management has become a part of our lives only after COVID. So maybe you can start from there, Mr. Mishra. Mr. Ashutosh Mishra.
Partially correct.
Oh, sorry.
Oh, Ashutosh Mishra. Okay.
Yeah. I'll just come back to you, Dr. Mishra.
Okay. I mean, let me take it on in a slightly different way.
Sure.
So when we say risk management has become part of our life, the key question that a risk manager would like to ask is that whether it has happened by design or it has happened by accident. So if I have designed a structured way to handle risk, then I have done it the way the risk management is supposed to handle that particular crisis. If by kind of stray attempts, I have managed the risk, that is not what risk management is supposed to do. So to Mr. Kedia's question, my counter would be, when we say that the risk management has become part of life because of the issues which has happened, the adjustments that we have we done it in an extremely structured and methodical way so that it takes care of variations, it takes care of spikes if it happens, or we have just kind of managed the situation? Just managing the situation, in my opinion, won't be the way that risk management is supposed to handle that. We have to subdivide the entire thing to processes and sub-processes and build in controls so that the entire risk is managed. So, well and good if we have become part of our lifestyle, but even then the risk management has the role to come up with an intellectual and understandable manner to put in a system so that risks are managed. Thank you.
Thank you very much. I think we're running out of the time, so probably I just summarize the insightful discussions that we had today. So, risk management is a culture. Opportunity and risk come in pairs. Risk awareness and risk de-jargonizing is more important. Automation is here to stay, so we have to deal with the risks that come with it. Risk management is about people and processes, not about just models and technology. And finally, I think what I hear everybody saying is, at the end of the day, there's no substitute for a seasoned executive who can make a judgment call. Thank you all very much for being on the panel today. It was wonderful discussing with you. There has been a lot of learning. And I, for one, will continue to be in touch with all of you, because this 1 hour time is not good enough to kind of imbibe all the learnings that the panel has to offer. Thank you very much. Bhavna, handing over to you.
Sure. Ms. Nayak, there's a great news right now. I just got to know that we still have a few more minutes are getting added because of all the expertise coming in from our eminent panel. So, Ms. Nayak, I would just like, if you could direct your panel to probably give some closing remarks, and I'll just see if there's any question further on coming in. I could direct the same to you.
That's wonderful news. So maybe we can move around to closing remarks from each of the panelists. Mr. Krishnan, would you like to go first?
Sure. From the question that risk was always part of our culture, probably yes. But I think in the financial services, somewhere from 1990 onwards, and then there is this famous Blue Book of Reserve Bank. which launched in 99 or 2000. I was in the banks then. As Mr. Ashutosh Mishra put it, sub-process, sub-function, sub-function, process, sub-process, what could go wrong, controls, checks, is something that I have grained in since 90s. So these are part of risk managers' jargon, as well as the job, as well as BAU, business as usual. What has happened now in the last 10 years is it's moved from that, which is business as usual, to more dynamism, more opportunistic risk management, technology-oriented risk management, decision-making, strategic risk management, and business risk as such. So that's the change. And the business CROs are now change influencers, change managers themselves, and part of the governance risk compliance epicenter of that now, and troubleshooters daily. And the daily intake of shocks and surprises is plenty for a CRO. Something new will come up every day, and so you ought to be up on your toes and up the curve.
Absolutely.
That's coming.
Ms. Nayak, there's just a question which has popped in right now. I'm just sharing it with our esteemed panel right now.
Okay.
Ms. Nayak, it is from Indra Vandan Mehta, and asks that how do you see commercial banking working capital risk with respect to AI and current obscure position? So Ms. Nayak, if you could direct that to the panel, we still have another 6 minutes on our hand. Over to you, ma'am.
Commercial banking, I think Dr. Rabi Mishra has to take it.
Sure, ma'am.
What is this? What is this working capital risk?
No, with risk, I'll just repeat it. Yeah.
Probably if Dr. Mishra answers, it's okay. Otherwise, it's fine for me to answer that also.
Okay.
You please answer this.
Yeah. Mr. Mishra, maybe you can take it.
You answer. So I'm getting the last question. So anyway, so Mr. Ashutosh can answer this.
Yeah, Mr. Ashutosh Mishra, if you can take this. Anyway, Dr. Rabi Mishra's mic is a little choppy, I guess.
Okay. Yes.
So okay, let me respond
It is
to
still like that?
Having been a commercial banker and having also handled working capital finance. So while there are set methods of computing working capital finance, I would totally agree that AI also could have a role in computation and assessment of working capital finance, because it would help a banker to understand what would be the working capital requirement in terms of movement of goods, movement of various components of working capital, movement of NWC. So it is quite possible that AI can also be used in working capital finance. But the question is, are we ready for that? Are we in a position to use that as of now? Are the banks geared to use AI for working capital finance? I won't know that, in fact, and I don't think banks in India have been using that. Maybe some of the NBFCs, very high-tech NBFCs, could be using that, but I agree that this could really add to computation of working capital, assessment of work. Thank you.
Sure. Thank you so much, Mr. Mishra. I'll just, yes, Dr. Rabi, would you like to come in? Though your voice is a little choppy, sir. Yes.
I'll do it slowly, but it is a, what is that called? Good point. Risk acculturation measures should enable each member of the firm to smell the risk in advance and alert the risk mentors. This will ensure the organization to remain risk intelligent, not just risk aware or risk conscious. So that is exactly should be the way risk acculturation should be done. This will be my punchline for this seminar.
Sure. Thank you so much, Dr. Mishra. Well, the last point was absolutely heard in all without any interruption, and that was so pivotal. I'd just like to request once, Mr. Syed, since we didn't hear from you, sir, just some closing remarks from you, and then we'd like to conclude the panel with Ms. Nayak. Mr. Syed,
thank you so much, Laura. Just picking a clue from one of the question is, has risk management started something after the COVID scenario? I think risk management is as old as human evolution. You know, even when a child, when he's born, he starts crying after he's born. He doesn't cry when he's there in the mama's, safe nest. So because he looks after a particular risk of survival, he panics and he starts crying, and that's how the whole mother nature makes him survive. His lungs starts pumping in blood across the body, his brain starts working, and he starts. So why somebody still cries, a control which is given by the nature. But even if you read the Darwin's theory, right, the whole human evolution started from the whole concept that the human brain is coded to manage risk and mitigate risk. Anyone gives you any work, the first thing that goes into your mind is how do you avoid that work? And then depends on who has given you the work, you plan in what time you has to do it. So I think a human ecosystem, the whole world is made to manage risk, and risk management is not a new subject. As sir also said, we need to make it more lighter, more common in terms of our vocabulary, and de-jargonize it to make it sure that every common person understands it. There are institutions who are taking efforts to go to even schools and make the entire concept of cyber, for an example, cyber risk, more simplified and easily understandable by kids, because they are handling gadgets now. So my closing remark is risk management is nothing new. It's part of our DNA.
Sure. Thank you so much, Mr. Syed. And Mr. Krishnan just said that, I just got it, that the DBS Bank in Singapore uses AI for treasury and working capital risk management as well. So thank you so much, Mr. Krishnan, for that point. And I just thought I'll tell it to all the viewers as well. So because it's all about enriching each other with information and knowledge. And when we have such incredible experts, who better can it be? Ms. Nayak, just one minute closing remark from you as well. I know you've done it before, but just one more minute, ma'am, for you.
Well, I would just like to add that risk management is more realistic term than safety. It implies that hazards are ever present, that they must be identified, analyzed, evaluated, and controlled, and rationally accepted. I guess that's it.
Thank you so much, Ms. Nayak. So ladies and gentlemen, with this, I'd just like to thank Ms. Nayak, Mr. Ashutosh Mishra, Dr. Rabi Mishra, Avez Syed, and Mr. Sunder Krishnan for joining us. Thank you so much for that incredible panel discussion. Thank you once again.
Thank you for this opportunity.
Thank you.
Thank you all. Have a good day.
Thank you.
Thank you.
Thank you.